Hi everyone, welcome to my channel. I'm Doris. I'm here to show us about my stock account and today's market updates. Today we're going to be talking about the European Alipay companies fell 70% on the worst day. The plight of the Europe's FinTech sector caught the spotlight of the Worldline surprised on its earnings report. At press time, Worldline fell nearly 58% on Wednesday. The company not only third quarter results, but also cuts its full-year revenue growth guidance from 8% to 10% to 6% to 7%. That follows Tuesday's cap payments, which landed on the London Stock Exchange on July, which recorded a staggering of 71.92% drop on a significant cut in its guidance. Looking at the K chart, we can clearly find out that the trend of this group of European fintech companies is very similar to the previous European wind power stocks, suffer speculation in a favorable environment, and then entered a continuous downward state, occasionally accompanied by several huge negative declines. For these European fintech platforms, the sudden change in valuations is also related to the dramatic change in the macro environment over the past few years. Low interest rates and the online spending habits during the COVID-19 pandemic have led to soaring valuations of these fintech stocks. But as interest rates rise rapidly and inflation further squeezes spending power, these growth stocks also sharply in the capital markets. Worldline said in its financial report that the third quarter of this year, some of the company's core businesses, especially the German market, saw a macroeconomic slowdown. As a result, consumers allocate more money to non-discretionary vertical products than optional consumer goods, which also affects the country's gross profit. The company also suggests that, given the surge of cybercrime, it has voluntarily terminated a number of merchants that do not comply with the stricter risk appetite policies. As rising interest rates and interest margins drive profit growth for traditional banks, and old-school and boring bank stocks are paying off, fintech suddenly looks less popular. The head of the market analyst at British wealth management giant RBC, Bruin Dolphin explained. Capital markets were also surprised by successive setbacks in the European fintech stocks. Most analysts give a Worldline a buy or hold rating. According to the statistics, Jeffrey analyst Hannes Littner commented that concern about the long-term downturn could create a more uncertainty about the recovery. Even so, many investors voted with their feet. Some investors choose to stick with their stocks. Worldline is the largest single shareholder in the SIX Group, which operates a Swiss stock exchange. As the position plunged, the SIX Group spokesman told the media that, strategically, Worldline's investment is important to SIX Group and in the medium and long term. In addition, increasingly active private equity firms also seen as a potential proxy for European fintech stocks. Last week, rumors surfaced that several institutions, including CVC Capital, were initially considering buying the Nexi. In June, Brookfield Asset Management announced it was buying Nascent Network International for €2.2 billion, and a month after the GTCR bought a majority stake in Fidelity National Information Services, valuing it at $18.5 billion. Therefore, they commented, "You can understand why no one wants to buy Worldline stock. A disappointing performance and another earnings warning and negative payments in the industry. By taking a step back, you also have to admit that there is potential for merger deals behind it." This is all I have for today. Thank you for listening. Don't forget to subscribe and see you next episode.